Good morning. It is Monday, July 14th, 2025. I am Herb Morgan, Senior Managing Director, Chief Investment Officer for Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary. If I have anything to say or there's any major news intra-week, I will post it on X with the handle at Herb W. Morgan or on LinkedIn with the handle Herb Morgan. Let's get started here. This presentation is designed by me to be used by you. Doesn't matter if you are a financial advisor or an individual investor. This presentation is designed for everybody, but you are expected to make your own investment decisions. Nothing contained in the presentation should be treated as investment advice. There's no tax advice. No recommendation for the purchase or sale of any securities. Everything is for informational purposes only. The opinions and views expressed are mine and mine alone. They may differ from the views of CFIA's parent, affiliates, or other portfolio managers at the firm. Well, we've had a series of up weeks and new all-time highs in the stock market, so I think it's only natural that we gave back just a little bit last week. Not much, about 0.3%. You can see here. The S&P 500, mid, small cap, international markets, all about similar. Even yields went a little higher. Bond market gave back just a little bit. Longer data, remember, the longer the maturity, the more elastic or more volatile the movement is in response to changes in interest rates. So the longer maturity 20-plus Treasury index, of course, had an exaggerated move when you compare it to the move of the aggregate bond index. We had very little in the way of economic data last week, very little in the way of economic news last week, and very little in the way of earnings. All of that changes this week. But let's talk about last week. We did get consumer credit for the month of May, up $5 billion, about half of what was expected. So that was, you could call that a disappointing report, but when you see that credit card and other revolving debt declined by $3.5 billion, well, on the one hand, that's good if consumer balance sheets are strengthening. But on the other hand, it's not so good if they're less convinced in the strength of the economy, less willing to assume revolving debt. So that signals a little bit of a decline in confidence. You can see the revolving credit, the red bars on here. There's not many negatives. This is sort of a usually up kind of thing. But they do occur. They definitely occur during recessions. We had a big one earlier this year, and then there is the month of May. We also got the minutes from the Fed's last meeting, which was June 17 and 18. And for the first time, we're seeing a division among the voting members on when to cut rates. Let's start with the two that I have previously spoken to you about. Michelle Bowman and Christopher Waller are both openly advocating now for rate cuts at the July meeting. That's this month, July 29 and 30. You know, I previously predicted based on inflation data. However, they continue to say in the minutes that they're concerned about what inflation might come because of the newly initiated tariffs. So they think they want to push it out further to September. Quite frankly, the last day of July versus the middle of September is only 6 weeks, so it could happen at either one of those times. The markets are definitely calling for September at this point. 10 people forecast 2 rate cuts by the end of the year. 7 are more concerned with inflation, so more inflationary hawks. They suggest no cuts at all. And 2 are forecasting just 1 rate cut, and a rate cut is defined as 25 basis points. Labor market, they say, is still strong, but has shown signs of softening. And if you recall, in prior episodes of this podcast, I've talked about the softening underlying part of the labor market that we saw in the June, particularly in the June employment reports. And we still are above 2% core PCE inflation. And as the members pointed out in their minutes, we have shown very little progress on that. I think the inflation progress changes in the fall when we start getting bad months of CPI data rolling off. So August of 24 was going to roll off, then September, October, and November, and those were pretty high inflation readings. That'll bring that core number down, and that'll give the Fed the cover it needs. You couple that with the fact that the labor market has softened. It's not a bad labor market. It's just softened a little bit. Makes me believe the rates will come absolutely no later than the September meeting. Speaking of jobs in the softening job market, well, it actually improved, at least in terms of layoffs last week. You can see here weekly initial claims for unemployment came in at 227. That was below the estimate of 235. And the 4-week moving average, that's 2 weeks in a row now. We see it coming down. That's helpful. We've had these spikes before, and it comes back down, and we're seeing that again. So that's a positive development. The other bit of news last week that I think it's always misunderstood, right? We got a budget surplus for the month of June, and certain folks online very excited about that, spinning it for political purposes. Unfortunately, there's really nothing to see here. There are 4 quarters a year in which quarterly tax payments are made, and therefore they will always be, or at least should always be, surpluses. So a surplus should always happen in June quarter, and they don't always, but they should. They definitely should always happen in the April quarter. And so if I wanted to find the good news here, and I think a lot of people want to find good news, and that's great, we're optimists. Last year, the April surplus was $200 billion. That's when most people pay their taxes. This year, the surplus was $260 billion, so that's helpful. Last year in June, even though it was quarterly tax payment, because we spend so darn much money, we had a deficit last year in June. This year in June, we actually had a modest surplus. So I know there's some spin on there, but I think the bottom line is we have a long, long, long way to go. We are getting, as I pointed out, real revenue from tariffs at this point, 25, 30 billion a month. That's helpful, but we need the DOGE spending cuts to come into play. Other cuts that might come from rescission bills now that the one big, beautiful bill has been passed. That forecasts massive deficits for years to come, but partly they're claiming that is because of the way they must score them. They can't assume GDP growth. They don't assume budget rescission bills, which the speaker has said they're going to be bringing later on this year. So what next? We kick off earnings season this week in a very, very big way. We had just a couple of names report last week, but really it gets going this week with the financials. BlackRock, JP Morgan, Wells Fargo, you name it, Bank of America, etc., all report this week. These big banks have passed their stress tests, and so they are now looking to deliver earnings to shareholders and return capital to shareholders in the form of dividends and stock buybacks. So I expect very good news this week. They also might decide to increase loan exposure, which would be stimulative for the economy. I know the administration is working aggressively towards stimulating the economy. One of the ways to do that is to give permission to banks to expand. But we also have some non-financial names kicking off the season this week. J.B. Hunt, Johnson & Johnson, United Airlines. We had Delta last week. They did fine. Pepsi, Abbott, Snap-on, General Electric. And the first of the tech names, Netflix, will report this week also. I told you there wasn't a lot this week, but that's just the way it is. There's nothing scheduled today. And Tuesday, New York State Manufacturing, CPI, PPI, Tuesday, Wednesday. Notice those numbers are expected to go up. That's not helping the case for a July rate cut, unfortunately for me. Weekly claims at 234,000 expected on Thursday. Import and export prices, Philly Fed survey expected negative. Housing market sentiment is miserable, and it's expected to stay there. Starts and permits very, very low, also expected to stay there. Consumer sentiment from the University of Michigan, also low and expected to stay there. Thanks, everybody. I'll be back to you again in 1 week. Don't forget, we're available everywhere. Best place, though, is YouTube because you get the charts and the graphs. Thanks. I'll be back to you again in 1 week.